Hello traders, it is my pleasure to introduce Jesse Colombo in Alpha Wave Trader webinar room. Jesse Colombo is Alpha Wave Trader partner who is currently an economic analyst, forex and futures trading instructor with Cyber Trading University. Jesse Colombo had been writing for Forbes.com and was recognized by London Times for warning about US housing and credit bubble as a university student. Jesse graduated with Bachelor of Science cum laude from Stony Brook University. Jesse, enjoy the webinar. Traders, here's Jesse.
Thanks so much, Ala. I appreciate it. And I enjoyed your webinar yesterday on our end.
Thank you so much.
So
Thank you.
today's topic, you're welcome. Today's topic is called Learn How to Use Intermarket Analysis to Your Advantage. And actually is a very good lesson considering what happened today, actually really in the past week or so, in the global forex and futures markets. And as you'll see, and I'm going to start out showing you the basic concepts of intermarket analysis, and then I'm going to show you the financial charts of the financial markets over the past few months and show you exactly how this works in real life. So let's get started. First, just want to discuss the risk disclaimer that all companies do. You know, the idea here is that trading is risky, whether it's futures, options, or forex, and Cyber Trading University and myself are not recommending any specific investments or giving investment advice. Everything here is for educational purposes only. So I just want to discuss my background. My name is Jesse Colombo. I'm an independent economic analyst and researcher. And when I was a university student, I noticed the housing bubble develop, and I was a little bit of a precocious young man. And I started studying trading and technical analysis and financial markets around age 15. And then by the time I attended university, from following the financial news and economic news, I noticed that there was this credit bubble developing, as well as housing bubble, which is an asset bubble, back in early 2004. And I built a website called stockmarketcrash.net to warn about it. And this became one of the 4 most highly trafficked housing bubble related websites, according to the LA Times, back in June 2005, so almost 10 years ago. And then when the bubble popped, I was recognized by the London Times for warning about that bubble and that crisis. And since then, I've become known for warning about dangerous post-2009 economic bubbles, basically new bubbles that are developing around the world in recent years. And I built up such a large social media following of about 100,000 plus followers that Forbes magazine contacted me a year and a half ago and asked me to write a column for them on Forbes.com. I've been doing that ever since. And there are many parallels between the study of economic bubbles and speculative bubbles that are developing around the world, as well as trading. And both have been interests of mine. So I basically tie the two together and write about various trading setups and technical analyses that I see in my column. And I'm going to show you some of the concepts that I use to forecast major moves. So first, I just want to discuss what is intermarket analysis. Many people are not aware of it, surprisingly, but it's a very simple concept, but extremely powerful. And intermarket analysis is using one financial market to predict moves in other related markets. And I didn't invent this concept. It was first discussed in detail by technical analyst John Murphy back in the 1980s, and he wrote 2 books on intermarket analysis, and I highly recommend them. You can find them on Amazon.com, used inexpensively. I think it's a wonderful addition to any trader's library, but I've added some of my own take to it, as traders and analysts typically do. We borrow ideas and we meld them together and we improve, and it's nice to be able to stand on the shoulders of giants like that. And I'm going to be showing you those concepts today. And intermarket analysis uses established relationships and correlations among currencies, commodities, bonds, and equities or stocks. So the idea here is that chart patterns, other technical signals in one market, often has similar implications in other markets that are correlated. I'm going to show you which the most important intermarket relationships to be aware of. And number one by far to be aware of is the relationship between the US dollar and other currencies and commodities. And there's an inverse relationship. So strength in the US dollar leads to weakness in non-US currencies and commodities. And we saw that since, especially in the past year, starting back in July. This is a pattern that has existed for at least several decades. But we saw this in a very strong way during this oil bust, where oil prices, or at least West Texas Intermediate crude oil, dropped from $105 per barrel down to around $44 per barrel. And it really confused so many people. Why is oil crashing like this? Well, you have to look at the US dollar and see what it did to understand that. I'll be showing charts shortly, don't worry. So it's the idea of this inverse relationship where the dollar rises and the euro falls, the Australian dollar falls, and so does oil and so does copper. And recently, the US dollar has actually pulled back a bit after its very powerful bull market. And that's one of the biggest reasons, in my view, why oil prices and gasoline prices at the pump have been going back up. Again, so many people are confused. They're trying to find all sorts of fundamental explanations as far as slowing inventory growth. But you know what? Keep it simple. Really, it's the dollar. I'll show you that relationship. The next most important relationship to be aware of is commodities versus bonds. That's another inverse relationship, meaning when commodities prices go up, bonds go down. When commodities prices go down, bonds go up. And in the past year of this commodities bust, or at least up until a few months ago, you saw bonds rallying significantly. And it confused so many economists and analysts because the Fed was tapering. So they thought bond prices were going to go down and interest rates were going to go up. But the missing link that they don't understand was because we had commodities prices were dropping significantly. And commodities prices are often seen as a proxy for inflation. So if commodities prices are going up, it usually means inflation is ahead. If commodities prices are going down, it usually means it has deflationary implications, or it means inflation is dropping. So bondholders do not like inflation. Bondholders receive a fixed income payment every 6 months, a fixed dollar amount, a fixed euro amount. So if gasoline prices are going up, if meat prices at the grocery store are going up, it's hurting their fixed income payments. So that's why bonds drop when commodities go up. And when gasoline prices go down, oil prices go down, bondholders are happy because it means their fixed income payments go further. So that explains that relationship. The next relationship, and this tended to be more a stronger relationship before the QE era, or quantitative easing era, of the past 7 years. This is a traditional relationship. I still want people to be aware of it just because this is, in general, an important economic and financial principle, but it's the relationship between stocks or equities and bonds. And in general, when you have a stock bull market, bonds tend to fall. And when stocks fall, bonds tend to rise. And as I said, the Fed's QE programs over the past 7 years has distorted this relationship a bit. But if we eventually get back to normal, where we're no longer so addicted to QE and money printing, this relationship will return. So when you have a strong bull market where stocks are going up, you have the economy booming, jobs are being added, there's less demand for lower risk, lower return assets like bonds. So capital shifts from bonds into equities. You have this rotation from one asset to another. People want to take risk. They're willing to take on more risk for the prospect of more reward. And when bonds drop in that type of bull market environment, that means interest rates are going up because bonds trade inversely with interest rates, essentially. So in a strong economy, you have higher interest rates. When you have a recession and a bear market, however, when stock prices drop and the economy gets weaker, people want to sell those riskier stocks and they want to put it into bonds because they'd rather have preservation of capital rather than higher returns. So that's that inverse relationship to be aware of. And then the other relationship, which I'm going to be going to great detail here, is the relationship between commodities prices and commodity currencies. And some examples of commodity currencies are the Canadian dollar, the Australian dollar, and the New Zealand dollar. There are many more, many emerging market currencies, especially many African nations, Latin American nations. Their currencies they pretty much move in lockstep with commodities prices because their economies are so heavily driven by mining and export of raw materials. So there's that positive correlation. And Canada is a major oil exporter. So one of the main reasons why the Canadian dollar has weakened so much over the past year is because of the oil bust. They've had the tar sands boom over the last 7 years or so. And when oil prices dropped, it hurt the Canadian dollar. Australia is a similar boat. Instead of producing oil, one of their biggest commodities that they export is iron ore. And they export that to China. And China was booming up until the last 2-3 years and building massive cities all over the country. And all of this led to incredible demand for iron ore, which is refined into steel. So over the past 2 years, China has slowed down significantly, and it caused the price of iron ore to crash. And that led to significant weakness in the Australian dollar. So my typical starting point when performing an intermarket analysis is watching the US dollar index. And you may not be a Forex trader or currency trader, or you may not even trade commodities. But if you trade stocks or swing trade stocks, I believe it is imperative to be aware of secular macroeconomic trends that are occurring throughout the world, because very often swing traders and stocks will be trading commodity-related stocks. I know if you followed the stock PBR, Brazilian petroleum company, Petro Brasileiro, one of the main reasons why they dropped, I know there's been corruption scandals and other issues there, but one of the main reasons why it dropped is because oil dropped. So even if you don't have a futures brokerage account or currency trading account, you can still play these views if you're aware of these broader trends. You can short commodity-related stocks. There are fertilizer companies, agricultural-related companies, companies like John Deere. So everything works together in the financial markets, and that's why I don't differentiate or compartmentalize these markets so much. They all work together. So my typical starting point is watching the US dollar index. The US dollar is the world's reserve currency. So it tends to be one of the most important drivers of global currency and therefore commodity trends. And what I do is I perform a technical analysis on the dollar index. And I'm going to show you that shortly, but I just wanted to show you the general trends. And I know these charts for this presentation stop in January. I did it just because so that you can visualize a lot of the action, a lot of the most important action of the past year a little bit more closely. And then I'm going to go to a live market analysis where I'll show you what I'm watching currently. So you can see over the past year, the dollar surged starting in July 2014, and that's because it's three main reasons. One, because the Fed was tapering or stopping its QE program, so they're printing less money. They're not weakening the currency as much as they once were. And at the same time that was happening, Europe's economy continued to deteriorate. So you saw there was some deflationary risks in Europe, and traders and investors were speculating that Europe's central bank was going to launch a quantitative easing program of its own. And that caused them to sell euros. And eventually that prediction was proven to be correct, because back in March, the ECB launched a 60 billion euro per month QE program up until it's slated to end in September 2016, but could go even longer if Europe continues to stagnate. So you have the weakening of the euro helped push up the dollar. You have the Fed slowing its or stopping its money printing program. And then you also had Japan, another weak economy similar to Europe, has been running its Abenomics or QE program for the last 2.5 years. And that's been weakening the yen, which has been pushing up the dollar. So the dollar is seen or was seen as the cleanest of the dirty shirts. So that's why you saw this big surge in the dollar. And I'll show you how to do a technical analysis shortly, but I just wanted to show you this relationship. And you can see this dollar rally caused a bust in commodities prices. So what we're looking at right now is the Dow Jones UBS Commodities Index. And just think of this index as similar to the Dow Jones or the S&P 500, but for commodities. It's basically an average of the most important commodities that are traded and used. So you have a very high weighting in this index of oil. You also have corn, you have wheat, you have copper. You have the whole gamut of commodities that are actively traded are included in this index, and it's nice because it shows you what the overall commodities markets are doing. And you'll notice that commodities plunge corresponded with the start of the US dollar rally. Just going to show you again, see? And as I said before, there's that inverse relationship between commodities and bonds. So you can see falling commodities prices boosted bonds. And this is exactly the opposite of what most economists were expecting. They thought the Fed's stopping its QE program. They're not going to be buying bonds anymore. So bonds should drop, right? Well, the exact opposite occurred. And to this day, they still don't understand why. And it confuses me. It's so simple. For anyone who understands basic intermarket analysis, you would know, oh yeah, commodities prices are dropping and bonds are going up because people want to own bonds at a time when inflation is dropping. That's really all it is. And that big bull market in the US dollar and the bear market in commodities hurt commodity currencies. So I'm showing you in this example the Canadian dollar. And falling oil prices started to hurt the Canadian oil sands boom. And Canada exports oil. So if they're receiving less revenues for their oil, it's gonna create less demand for their currency. And you can see that's one of the main reasons why it dropped. Right around that same time, by the way, too. This is the Australian dollar, same pattern. Australia is a major commodity producer. They export all sorts of agricultural products, all sorts of natural resources, raw materials, everything from gold to, as I said, iron ore, various metal ores. You can see those prices dropped, and so did the Australian dollar. So here's how I apply intermarket technical analysis. Step 1, you want to identify correlated leading markets first, meaning, in this case, commodities and the US dollar tend to lead commodity currencies like the Australian and Canadian dollars. Step 2 is you want to find chart patterns or other actionable technical information in the leading market. So for example, you'd look for a pattern like a bearish head and shoulders, bearish head and shoulders in commodities prices, and that creates a bearish bias for commodity currencies like the Australian dollar and Canadian dollar. And the third and final step is you want to look for technical confirmation in the lagging market. So you want to look for a bearish confirmation in the Australian dollar or Canadian dollar after the bearish commodity signal was given. So don't worry, I'll show you this in a visual manner shortly. So we're back to this chart of the US dollar index. And I don't know if many of you follow the US dollar index actively, but if you'd like to follow along, I'm going to give you a link to that just because many people don't know where to find the US dollar index chart. But I'm going to give you it's a free website I use called finviz.com, and I find it quite helpful. I love this site, by the way. I look at a lot of different commodities, currencies on there, global stock indices, very useful site. So what I do is I analyze the US dollar index first, and you can see this was back in June and July. You can see there was bullish technical action. You can see in late July 2014, the US dollar index broke right above 81. And that was a prior high that we saw back in January, February 2014. So when you see a market break to a new high, that's typically a bullish sign. It's heading into new territory. That's a good sign. And you see in early August 2014, it formed a consolidation pattern, a trading range for about 2 weeks for most of early to mid-August. And then it broke above that one. And that was your second bullish technical signal. And then it kept on rallying, and then eventually formed an uptrend line. I know I'm showing you this in hindsight, but I actually did show my followers, my personal social media followers, and also discussed this on my Forbes.com column as it was happening and unfolding, especially a lot of these rebounds off that uptrend line. And you can see I connected the lows of the US dollar index, and you could tell there was a high probability every time it touched that and then bounced off that it was going to continue on higher. And every time it continued on higher, it pushed commodities prices down even lower. I know, I'm sure many of Ala's technical analysis techniques are useful if you're watching the US dollar index, and I agree with a lot of what she was saying and her philosophies. So, you could possibly use that to analyze the US dollar index as I did here. So next, you can see I'm analyzing the Dow Jones UBS Commodities Index. And last spring, about a year ago, you can see there was a bearish head and shoulders pattern, a clear pattern. This is a textbook bearish head and shoulders pattern that formed for most of last spring. You can see the left shoulder in March 2014, the right shoulder in late June 2014, and you can see the head pattern in late April. And that neckline, or that support level, was right there, that formed connecting those lows. It was right around 132.5, 132.5. And when that pattern broke down, the bearish signal was given when it broke down in early July. It broke that support. That was not a good sign. And then it continued to drop. There was another similar signal that happened back in early December. And I know that's when OPEC said that they were not going to cut production as many people in the market expected. And it caused oil and so many other commodities to drop. But you can see the commodities index, there was a support level at 116 for about 2 months. Kept on bouncing off, finally plunged underneath there. And that was another technical breakdown. And let me see. I see some questions coming in. I'll take questions actually toward the end, and many of these questions are going to work very well with the live analysis that I'm going to do. I mean, as I say live, I'm not going to be doing day trading, but I'm going to be showing you what I'm currently watching. And that's a very good question as far as the U.S. dollar index having a head and shoulders. I have a lot of thoughts on that, as you'll see shortly, but I just wanted to discuss the important concepts first so we're all on the same page, and then we can look forward. So I showed you analyzing leading markets first. I'm showing you just these examples for now as far as the U.S. dollar index and commodities. I'm sure there are many others, but the typical starting point I look for is the dollar, just because that's the most important, or one of the most important driving markets for the global financial markets, just because the dollar itself is the world's reserve currency. And there's that inverse relationship between commodities and the US dollar, and there is no such relationship like that with other currencies because they're not the world's reserve currency. So next we want to look for confirmation lagging markets. You can see the Canadian dollar, believe it or not, formed a bearish head and shoulders of its own last summer, summer 2014. You can see the head or the peak of that pattern was in early July 2014. The neckline was right at 0.91. I'm showing you the Canadian dollar futures here, not the US dollar Canadian pair. So it's just, think of it as inverse. It's just flipped basically. I showed it like this just so it's a little more intuitive that when the chart goes down, it means the Canadian dollar is going down. And you'll notice that the Canadian dollar's top occurred at the same time as the sell signal in commodities. So you can see the sell signal in commodities occurred in early July. Well, that was the top in the Canadian dollar. Very interesting, and it's not a coincidence. And you can see that there was that neckline support level, that horizontal line I drew right over here in the Canadian dollar. And when it broke underneath 0.91, that was a bearish confirmation. And you can see it continued to plunge for months later. This was one of the biggest moves in the Canadian dollar in many years. And certainly one of the biggest bearish moves since, I believe, since late 2008, early 2009, when the US dollar surged because of the global credit crunch, and all non-US currencies and commodities plunged as well at that time. You can see the Australian dollar as well formed almost a perfect bearish head and shoulders last summer. And you can see that support level, that neckline, was at 0.92. And just kept on bouncing, bouncing, bouncing. And finally, it broke down in mid-September 2014. And what I find interesting about this is this Australian dollar sell signal was given 2 whole months after the commodities sell signal. I'm going to go back to that chart. So you can see commodities broke down early July 2014. The Australian dollar sell signal was given 2 months later. So that gave you plenty of lead time to prepare or maybe take a bearish stance on the Canadian dollar, Australian dollar, or even if you don't trade those, possibly the stock indices or related stocks, certain ADRs, and certainly commodity-related stocks, they all plunged. I know gold stocks plunged. Those have been a disaster. I know oil stocks, certainly, especially fracking-related oil stocks. I know Bill Ackman called them out 2 days ago, saying oil stocks, he's still skeptical of oil stocks right now, but I can discuss that in my market analysis shortly. Also, I like to find confirming chart patterns. Confirmation is key when it comes to trading. This is just based on my own observations and experience, that what trips up so many traders, aside from obvious rookie mistakes like not cutting your losses or not trading with the trend, what trips up so many traders is head fakes, where you'll see a market look like it's about to move, or it does break out and you go long, for example, for a bullish breakout, and then all of a sudden it drops down again, and now you're stuck in a long position at a loss. That's called a bull trap. And the same thing happens to the downside. You'll see a bearish breakdown and you short, and then all of a sudden it rebounds right back up. And it's happened to all of us. I know it's happened to me before, and that's one of the biggest things that I believe in trying to avoid. Exactly. Fake out, breakouts. I know people call them algo head fakes. I know some traders believe it's caused by algorithms that try to intentionally fake traders out just to generate orders, and then it goes the opposite way and causes the market to move in the high frequency traders' favor. So these are all things we have to watch out for. But I find that using intermarket analysis and using multiple markets to confirm one another reduces the probability of false moves. So I'm going to show you one example of this. You can see this is crude oil, and I showed these little triangles. They're called bearish pennant patterns, for those of you who are not aware. They're continuation patterns. It's a very simple pattern, but you'll find them quite often. And again, I'm not showing this in hindsight. I wrote specific columns about this and showed my personal followers both of these patterns in oil, and they really did play out the way I was concerned about. I know the first one back in December 2014, that was right after oil plunged, when OPEC said that they were not going to cut production. And at that point, I remember, if any of you were following CNBC or most of the mainstream financial media, so many pundits were saying, is this the bottom? They thought it had to be the bottom. Oil fell from $105 per barrel down to 70. It's got to go up. Let's buy. I remember that. And when I saw that pattern in early December 2014, I said, uh-oh, this puppy could really break down even more here, assuming it's confirmed to the downside. And sure enough, that's exactly what happened. It broke to the downside, made a nice 10 $10+ move, $12 move, and then it formed another pennant pattern. I showed that as well on my to my followers on Twitter. You can see late December 2014, another pennant broke down from there. And what's interesting is that the Canadian dollar did the same exact thing. You can see it formed the pennant in early December 2014 and also late December 2014. And I'm just going to show you back and forth. Just look how similar those look. And the fact that you had multiple markets confirming it definitely helps to increase the probability that it's going to be a successful trade, assuming they both break out at the same time, break down at the same time. That's what I look for. So that was just an introduction to the principles of intermarket analysis. Now I want to show you what I'm currently looking at in the Forex markets. I'm just going to bring up the charts right now. As you know, the US dollar index has been breaking down significantly. I've been tracking this quite a bit, and that's the typical starting point. And I've been showing this. We run a trading chat room that's very popular at Cyber Trading University called Cyber Group, and I do daily updates every afternoon. And I've been showing our traders this on the way up, and then I was showing that the US dollar index formed a trading range for most of the past few months. And you can see the bottom of the range was formed by the highs that we saw back in late January and most of February. And you can see it's also the lows that we saw back in mid-March. And it was just bouncing around. I didn't know which way it was going to break out because I don't try to predict markets. I just react to them. And you can see there was a little bit of a false breakout above this prior high. Was unable to do it. It formed a candlestick pattern here known as a shooting star. And when I saw that, I was concerned. I said, uh-oh, you know, if the shooting star forms below an important resistance level, it's a cause for concern, but I want to see confirmation. You want to see a solid bearish down day the next day to confirm it, and that's what happened. You can see, sure enough, we got the breakdown. Then we got the breakdown below that important support level that we saw back here. And then I showed the next line in the sand I was watching was the lows that we saw back in late January and most of February, because you can see there was another trading range over here. So it fell and then bounced off, rebounded back up to the prior resistance, and now it's falling again. So it really caught in another range, pretty much the same range that it was back in January and February. So now I'm waiting to see if there's going to be a further bearish confirmation. So this does look kind of like, well, I wouldn't call it an orthodox head and shoulders pattern. It looks like a double top right now. I want to see if it's going to break below this next support. If it does, you can see a further unwinding of this dollar bull market. And I'm going to show you another chart. I'm going to pull it up. I posted for my Twitter followers a few hours ago. Major breakdown that we're seeing right now in the US dollar index. So you can see right over there, there was that uptrend line that I was following. I showed earlier in the presentation. And you can see it just broke down in the last week. It retested it a bit. And today was another solid bearish day. So that's not a good sign. I certainly would not want to be long the US dollar right now. But going back to intermarket technical analysis, weakness in the dollar is good for commodities. And I'm going to show you that shortly again, just to show you. So you can see the dollar topped out right around March 12th. It topped out again on just a month later in April, mid-April. And then now has been falling. So now let's go take a look at oil. Let's see what it's doing. There we go. So you can see oil's rising. I show this many times that there was a trading range between $54 per barrel and $44 per barrel. And I was just watching. I know there was a false breakdown that we saw back in mid-March. And when I saw that, I was concerned. I said, uh-oh, it looks like there could be another leg down. But the pullback in the dollar caused it to rally back above. So this was a false breakdown or a bear trap. And then the continued weakness in the US dollar over the past 2 months caused oil to rise. So there's so many analysts who are still saying, they're still trying to retroactively apply these fundamental reasons why oil is rising. You know, inventory growth is slowing, and all sorts of different reasons, but I'm not buying it. I mean, I know that there is some degree of truth to it, but we still have a big oil glut. I mean, I know that there is some degree of truth to it, but we still have a big oil glut. We still have a massive supply. I believe it's around 80. We're at about an 80-year high for oil inventories. That's not typically the environment where you want to be going long oil, just based on fundamentals alone, mind you. Yet the reason why oil rebounded was because the dollar pulled back. I'm just going to go back to that chart just so you can see. So that's why what I'll do is I'll watch the next level, and that's what I'm doing right now. I'm watching this support. See, I'm just connecting the lows back here. There's a little bit of a high here. If the dollar can break below here and keep dropping, then I would expect oil to keep on rising. So that's really just what I'm watching for right now. Just you'd be surprised how commodities markets, especially oil, are driven by the forex markets, and there's so many trading algorithms now that actually tie commodities prices to certain currencies, usually the euro and the dollar. So if one, let's say if the dollar gets out of whack with oil, or the euro gets out of whack with oil, the program will sell the overpriced one and buy the underpriced one, and basically bet that it's going to return, that ratio is going to return or converge. So, and RL was asking if there's a dead cat bounce in oil. You know, that's a very valid question. I'm still skeptical of this oil rally, you know, and I would never bet against a trend. I don't believe in betting against a trend, no matter what the fundamentals say. If you see technical strength, you don't want to bet against it, because sometimes you don't know the news. Sometimes you don't know what the market is anticipating. And that's the way to really get killed, is if you're, let's say, shorting in an uptrend or trying to catch a falling knife and go long in a downtrend. That's why I do respect technicals, but from a fundamental perspective, I'm still not convinced that this is going to be a sustainable, really big oil rebound. But I'm going to let the technicals tell me what's happening. And something interesting that I am watching right now, a few days ago I showed our cyber group members that there was a pennant pattern that formed here. And that was a bullish pennant. You can see it broke out to the upside. So that was a positive sign. Also, it's still above that $54 support. Looked like there was a double bottom that formed. And also the fact that oil broke above $60. So $60 is an important psychological level. I watch psychological levels. They tend to form support resistance levels. But something that concerns me is that this could be a bearish shooting star pattern. It's a candlestick pattern forming in oil right now. So I'm just going to keep my eyes on that. And if, let's say the dollar does rebound to the upside, and there's a bearish day, a big red down candle, then I would be concerned about this, about the health of this uptrend in oil, and also oil stocks, and therefore the Canadian dollar. I'm also watching this uptrend line in oil as well, so just watch that. Looks like it could be a channel, believe it or not. So just watch that, and that affects the Canadian dollar. All right, RL, we'll take a look at the euro next, definitely. So you can see U.S. dollar index trades inversely with the euro, and it almost looks like a complete flipped version of the U.S. dollar index. And the reason why is because the euro has the highest weighting in the U.S. dollar index. So that's why it looks very similar. It just looks like a flipped version, essentially. But I still watch the euro because there's a lot of key technical levels or certain subtle nuances that the euro may have that maybe the U.S. dollar index chart doesn't show. And I believe it's very important to watch. And I was watching this range that the euro was trading in between 1.11, sorry, 1.10 and 1.11. That was the resistance zone I was watching, and I was watching this support, basically just the two lows. right around 1.05, and you can see it just bounced, formed a double bottom. It cleared that resistance zone, formed a little bit of a pennant type of pattern here. And then I was watching this zone right over here. You can see it was a support right over here, right around 1.13. So I wanted to see if there was going to be a solid bullish confirmation in the euro, and we got it. And part of the reason why is because the US dollar fell. So let's say if the US dollar drops below that support level I was showing, then I would expect to see more bullish action in the euro. But let's say the US dollar did bounce off that next support I was showing, then that would probably put the kibosh on the euro rally. But for now, it's looking strong. I just want to see if there's going to be that next breakdown in the US dollar just to confirm the bullish action in the euro. And Ann was saying the euro, dollar index, crude oil are all expensive on daily, hard to play on futures. I know it all depends on your account size. I know a lot of those futures contracts are quite large for retail traders. Personally, I really wish the CME or another exchange would come out with a micro contract for oil, and I think they have it for the euro and some currencies, but there's an e-micro contract for gold. There's the standard gold futures contract's 100 ounces. That's very large. 100 ounces of gold. You have to have a very large account size to trade that. But the e-micro is an electronically traded micro futures account for gold. It's just a 10 ounce. I know some people say it's bad liquidity. I've never had a hard time moving a few contracts in and out, even at night. And I know I would not want to be day trading that for sure. I know they're very thin. They are. That is the difficulty with it. I know you're never going to get the kind of fluidity and liquidity of the full size contract. But for small traders, I don't think it should be that much of a problem. But I personally prefer more liquid markets, and in that case, that's why you have GLD, the ETF. You have USO. Sometimes you can trade that on margin if you want a little bit more leverage. You can trade options on that. There's different ways of going about it. So that's the euro. I'm going to take a look at some other non-US currencies. You can see because of the pullback in the US dollar index, the British pound jumped a bit. Let's look at the Australian dollar. You can see same thing. You can see the same bottoming in action. And if you folks want to type in certain currencies you want me to take a look at, I'll definitely be happy to take a look at them as well. And let me tell you, I've been watching the US dollar, Japanese yen. I'm showing you this on weekly. And I find this pattern to be very interesting. Whoops, I drew an extra line by accident. This looks like some sort of a wedge that's developing in the dollar yen. So for those of you who may not be familiar with Forex pairs, when this chart is rising, it means the US dollar is strengthening and the yen is weakening. And over the past 2 years, the reason why the yen has been weakening so much against the dollar is because of Japan's Abenomics program. Japan's been flooding their financial system with liquidity just through their quantitative easing program. They're printing money basically. They've been trying to weaken their currency to try to boost exports and to pump liquidity into the financial system. And yet their economy is still stagnating. And I think Europe's going to be the same situation. That's what happens when you have such a massive debt overhang. Japan has 200% debt to GDP ratio. And also demographics, as RL said, very astute. Yeah, exactly. They have both of them. There are a lot of parallels between Japan and Europe. You have unfavorable demographic trends, meaning the population is aging. And because of the low birth rate in both of those countries, you have pretty much almost like an inverted pyramid of many older people and a smaller working age population. And when you see the reverse, like when you see many young people and a smaller population of retirees or other dependents, that's when you have a strong, vibrant economy. That's like what the United States was back during the post-war economic boom after World War II. That's one of the reasons why we had such a strong economy, is because you had all these soldiers coming back, and people weren't having kids during the Depression of the 30s and the war years of the 1940s, and then in the 50s, all of a sudden there was this massive baby boom. You know, all these baby boomers start having. That was when the baby boomers were all born, and you had explosion of suburbs and all sorts of development, and that led to this vibrant economy. And in Europe and Japan, you have the opposite, and that's why I think QE or quantitative easing or money printing is. I don't think it's going to end anytime soon in Europe and in Japan, and they may stop it intermittently. Maybe they'll stop for a few months, maybe 6 months, maybe a year to see if the economy can take off on its own. But chances are, because of that debt and because of a lot of those issues that have been causing the problems that have not gone away, I think they're going to have to keep on going back to it. And I even think the same thing could happen in the U.S. Like look at all the bad data that's coming out in the U.S. over the past month. One of the reasons why the Fed tapered and why the dollar was rallying was because it looked like we were finally achieving escape velocity as far as the economic recovery. And then now all of a sudden we have all this bad data coming in, bad payrolls data and disappointing Q1 GDP growth, and a lot of that has to do with the oil bust. And that was one of the major drivers of our recovery was this surge of activity in North Dakota and all sorts of, unconventional oil drilling. And that's been driving a lot of jobs growth. And now you have this oil bust and companies are slammed on the brakes of CapEx and spending for oil drilling. They're idling their rigs. They're laying off oil workers. And now you have this weakness. And now, exactly, now Janet Yellen, the Fed, many market participants are now taking a dovish shift, meaning they're expecting that the Fed's going to have to keep interest rates at 0% for even longer. And I know many of my Twitter followers and other followers who follow me on, read me on Forbes.com or Facebook, etc. Many of them, along with me, have been speculating that at some point, will they have to launch a QE4? I know we're not at that point yet, but it's really something you have to keep in the back of your mind. And I know after QE2, many people thought we were not going to have to do a QE3. And then sure enough, we launched QE3 in late 2012. So, and that's what I'm watching in the dollar yen right now, is you have this trading range in the dollar yen. And now economic numbers coming out of Japan are showing stagnation once again. And there's been some speculation that Bank of Japan may need to actually increase the size of their Abenomics QE program once again. So if that happens and we see a breakout of the dollar yen from this wedge, I wouldn't be surprised to see another big move. Maybe a move like what we saw back about a year ago, or pretty much starting last summer. Maybe not that large. Maybe a move like we saw back in late 2013. But it needs to break out in order to confirm that. I'm not predicting it, saying this will happen. I'm just saying it's worth watching. It's an interesting thesis. And then there's some really bearish analysts out there who are saying that because Japan's going to have to keep on printing, that at some point the yen is going to weaken even more. And that we can even see the yen, eventually if there's some sort of a crisis in Japanese government bonds. I know people have been predicting this for years. It's called the Widowmaker trade. But eventually, if this were to happen, I saw some analysts speculating it could hit 400 to 1 US dollar Japanese yen. So, and Anne just brought up a good point. Japanese yen futures looks opposite of what I have here. Yes, absolutely. And I'm going to explain why. The chart I'm showing you right now is the US dollar yen. So when this chart is going up, it means the dollar is rising, US dollar is rising, and the yen is weakening. So every time it goes up, it means the yen is going down. That's the US dollar yen currency pair. But if you look at, let's say, Japanese yen futures, on the other hand, I'm going to pull up a chart. Bear with me a moment. Here's the Japanese yen futures. You can see it looks like it's just the opposite, because this is the Japanese yen versus US dollar. So what's interesting is The Japanese yen futures in the United States are priced in dollars. But it's really the same implications here. The idea is the yen kept on weakening. You can see that same wedge, that little wedge I was discussing. That's this little pattern right over here. So I'm just watching this. This could be a very interesting trade if it breaks out, if you're concerned about debt in Japan. Okay, another market that I'm watching is gold. I know a lot of people are interested in gold. I'm interested in gold. I like the idea of gold in the longer run. I'm concerned about you have so many central banks that are just printing and they're racing each other to the bottom, as RL says. And you think it would benefit gold over the longer run. And I believe it will in the very long run, but in the short term, technicals rule. So I'll show you what I'm watching in gold. And this ties into the US dollar index because the US dollar typically trades inversely with gold, like most commodities. So let's say if there is a further breakdown in the dollar, that could be bullish for gold. On the other hand, if the dollar bounces and heads back up to its prior highs, it could push gold down even lower. And I'm showing you the monthly chart of gold. And you can see there was this big breakdown about 2 years ago. That was when the the Fed first or when market participants first started discussing the taper or the ending of QE, and that caused gold to sell off. And since then, gold's been in this trading range. So I'm watching if this is some sort of a wedge as well, similar to the Japanese yen. You see these kind of patterns very often. And the prior trend was down. So very often you see wedges and patterns like this will be continuation patterns. Not always, but the majority of the time they will be. And I always wait for confirmation in the form of a convincing breakout or breakdown. But I'm watching this pattern. You can see the lows or the support is right around 11.50 per ounce. The highs you can see is right around 12.50 or so. I want to see, let's say, because the Fed is looking to tighten eventually. Eventually, they're probably going to raise rates. Maybe if it's not in the next year, maybe if it's not in 2015, maybe it'll be 2016. At some point, they're going to try to normalize monetary policy. And gold probably won't like that. That is if we don't have another recession, and where they have to launch QE. If that happens, then you'll see gold break to the upside. But if it breaks to the downside, then I wouldn't be surprised to see gold hit 1,000 or maybe even lower. So I'm just watching this. I'm not predicting. I'm just not that smart to be able to predict in advance. I'm joking when I say that, but I don't believe in predicting markets when it comes to short-term tactical moves. I just believe in reacting because there's so many different factors that move the markets that you really can't predict, maybe 3 months from now that Greece is going to leave the Eurozone, or if it's going to be 6 months, or if another black swan will come out, or maybe bullish news to the upside. It could. So that's why I just follow the trends and wait for the breakout. So I'm watching gold here. I just find this to be very interesting. I would like to invest in gold in the longer run, but I would rather invest at 1,000 an ounce or 800 an ounce rather than 1,200. Let's say if it's going to head down there, or if it's going to head back up to 1,800, I'd probably like to get in at 1,300 if it starts to break out to the upside. So I'm just watching this. All right, folks. So do you have any questions at all? I mean, any markets you want to discuss? I love technical analysis, and I'm similar to Ala in the fact that I like to take a minimalist approach when it comes to technical analysis. I know there are many people who use so many different indicators. I like indicators. I think there's a role for them, but I think it's important for traders to be able to train their minds so that they can determine and analyze pure price action, where they can just look at the charts and they can almost be a tape reader and look at the charts and understand that first before looking at lagging indicators like MACD or stochastics. I have some systems that I use that I find to be very useful that use some of those indicators, but not the way most people would expect. And I think it's important just to learn the chart analysis first. All right, yeah, we'll take a look at the German DAX. I actually had someone else ask me in our cyber group room that today. Let me just get my chart. Again, this is finviz.com, free site that I like very much. See, it looks like it formed a little bit of a head and shoulders in the past month and a half. And there was a neckline. If you can see the lows that we saw in late March and the lows that we saw in mid-April, I was watching that as a support level. And then in the past week or so, it broke underneath that. That's not really a good sign, especially the fact that it tried to break above that key psychological level of 12,000, kept on pushing, formed a little bit of a head and shoulders, and then now is breaking down. It doesn't necessarily mean that this Euro QE induced surge is over. All it just means is that this is a pullback for now. I wouldn't want to be going long on a breakdown like that. So now, as far as an intermediate term support, I'm watching 11,000. It's a major psychological round number. It's also the highs of that little consolidation pattern we saw in early February. If it breaks below there, the next level I'm going to watch is 10,000 and just above it, because that's the highs that we saw for much of the past year, and also just because it's an important round number. So I'm watching that. I want to see if it could bounce off 11,000 and maybe head back to the highs. If it can't, then I'm going to watch 10,000 and so on. But I just watch prior highs, prior lows, and major round numbers, just because there's likely to be some sort of bounce at those levels. All right, S&P 500, good. That's a good one. I always show that. Just going to zoom out a bit. It's right now. There's a lot of slop and chop in the S&P 500. There's really not a clear signal yet, but I'll show you what I'm watching to determine whether there's going to be a clear signal at some point. The S&P 500 has been trading in a pretty clearly defined range since mid-February. So you can see the prior highs. See it bumped its head there as a long upper candle wick. Tried to break above, was unable to do it, fell. Then on Monday, it retested that, tried to break above, unable to do it, and then bounced back down. So it's still in that range. It's not a bearish signal. It's not a bullish signal. I want to see one of these levels broken to give the next confirmation. And exactly, and that's trading the slop is the worst, because, and that's when technical indicators like stochastics, that's when they tend to give a lot of whipsaw signals. So that's why I like to use pure chart analysis in conjunction with those indicators. So if I know that we're in a range like this, I know that those indicators are not going to tell me much until there's, let's say, a solid breakout above this high on very high volume. And I would want to see the NASDAQ do the same, as well as the Dow, all on high volume. And then that would make me a little more convinced that we're seeing, another breakout to the upside. On the other hand, if there's a break below 2040 on high volume, then that would be another bearish signal, another bearish confirmation signal. I would want to see the other markets confirm. I like to reduce the chance of head fakes by looking at multiple markets, and that's really very much my style. All right, I'll take one more. Mario asks for MXX Mexican Bourse. Yeah, I like to look at emerging markets. They tend to make some wild moves, which is very exciting. And Mexico was another country that was benefiting quite a bit from the oil boom. I'm pulling up another charting platform. Just bear with me. Here we go. So here's the Mexican Bolsa stock index. So you can see it came near the prior highs, tried to push above. So you can see it came near the prior highs, tried to push above 4,600, was unable to do it, but it's still in a confirmed uptrend. You can see it's still making higher highs and higher lows. I can't draw it very easily on this chart, but actually I can. Let me see. I'm watching this, or I would be. I haven't been following the Mexican market in a while, but this is just what sticks out to me. Look at that. So you can see that uptrend line. So I would want to see it if I would, let's say, long or considering going long. I'd want to see it continue to follow that uptrend line. And also I'd want to see it break above this high that we saw in September 2014. I'd want to see it break above 46,500. If it can, then that's a bullish signal. If it breaks down, like many other markets, then that's a bearish signal. I mean, it's pretty simple, but I look at many different markets as many different systems. I'm just showing you a portion of it, you know, and I do a lot of these. I do these type of analyses all the time in our cyber group room, and I actually wanted to invite you to attend that cyber group room. I'm doing analyses every day. I'm just going to pull up that little that web page right here. So it's our trading room called Cyber Group, and it's extremely popular. It's one of our most popular services that we have at Cyber Trading University, and we cover many different markets in here. During the typical U.S. trading session, we're trading the most volatile, biggest moving stocks, trading it on intraday, and that uses the system that our CEO Fausto Puglisi has developed. It's a very revolutionary system that allows you to follow the smart money in small, fast-moving NASDAQ stocks as these stocks move up and down. And it works very well, and I mean, it works remarkably, and just don't take my word for it. Come into the cyber group. I'm going to give you the link, actually, and we have a free trial where you get a full week for just $29. So you'll come on in and get a chance to see how it works. And what we have is we have so many traders and a lot of moderators who are professional traders. And I'm in there all day long as well. We have Rich Lepis, who's my colleague. He is a phenomenal trader, and you'll see that in real time. Don't take our word for it. See the call outs that our traders are making during the day, and our students, and they are making significant money. They'll trade whatever's the biggest moving stocks that day and look for these entries and exits, and that goes along with the course that Fausto, the CEO, teaches. But come on in. You know, I'm not going to explain so much more, and you'll get a chance to try it and just see if it's for you. And at the end of every day in Cyber Group, I do my daily Forex and futures, swing trading, and options analysis. And I take questions from students just like this. You know, people say, hey, let me know what you think of Apple's chart. And I'll pull it up and I'll do it. And very popular service, so check us out. And also, if you folks have any questions for me, you want to learn more, shoot me an email at Jesse@CTU Trading. I just love to chat about trading markets, bubbles, global financial trends. And I also do personal coaching, one-on-one coaching. So if you're interested in having me guide you using the systems that I use, which includes a lot more than I showed today, and basically show you what I'm watching, you know, whether it's for day trading or futures, currencies, etc., I can help out with that. So
thank you, Jesse.
looking forward to seeing
Fantastic
you
to
all.
have you.
Thank you so
Thank you,
much,
traders.
Olive.
Thank you for your time. It was incredibly interesting webinar. Have a beautiful afternoon, everybody. Look forward to having you again. Thank you, Jesse.